Thank you all for joining us for this annual general meeting of the Biotech Growth Trust. This past fiscal year was a very challenging one for the trust, and we are working hard to restore the fund's outperformance. Having said that, I think there are many reasons to be optimistic about the outlook for biotech going forward. Let me first start with an update on OrbiMed, our investment management firm. We have total assets under management in excess of $17 billion, and that is spread among a number of business lines shown in the pie chart on the left-hand side of the slide. You can see that the Biotech Growth Trust, as well as its sister trust, the Worldwide Healthcare Trust, represent a majority of our public equity business. And we have continued to expand headcount over the past few years. So we have 139 global employees right now, and we hired over 25 new professionals over the course of 2022 and 2023. Now, one very important development for the Biotech Growth Trust is the recent appointment of Josh Gollum as a co-portfolio manager of the Biotech Growth Trust. He is a partner on the public equity team at OrbiMed. He joined the firm in 2021, and he brings with him close to 20 years of experience investing in biotech. So he's worked for a number of other investment firms over the course of his career, most recently a healthcare dedicated hedge fund called HealthCore, and he does have an engineering degree from Columbia University as well. And I think his appointment really reflects our longstanding commitment to the success of this fund and our willingness to add resources to the fund in order to enhance performance. So let me talk about this challenging fiscal year that we've had recently, ending March 31st, 2023. Here's a graph showing the Biotech Growth Trust NAV in black, the price in purple, and the performance of the benchmark index, the Nasdaq Biotech Index, in gray. And this graph starts at March 31st, 2022, the start of the most recent fiscal year, and the vertical black dotted line shows the end of the fiscal year, March 31st, 2023. And you can see that over the course of most of the fiscal year, actually the fund NAV was performing roughly in line with the index, but we did have a particularly bad March of 2023, so the last month of the fiscal year, and that was really due to two factors. First was the failure of Silicon Valley Bank. Many emerging biotech companies did do business with Silicon Valley Bank, and that spurred an investor panic when that occurred. And the second factor was the disappointing post-market performance of one of our Chinese positions, a Chinese vaccine company called YS Biopharma, that went public via SPAC and subsequently saw a rather sharp share price decline that we attribute to SPAC-related trading dynamics rather than fundamentals. We continue to believe that particular company is significantly undervalued, but the share price has not recovered just yet. Now, to the right of the dotted line, so since the end of the fiscal year, you can see that we have begun closing that relative performance gap versus the benchmark index. We have much more to go, obviously, and we will be working hard to restore outperformance of this fund. But that's basically in a snapshot of what happened during this past fiscal year. Now, another headwind that we faced over the fiscal year, aside from those two events in March, was the fact that small cap and mid cap stocks in the biotech space continued to underperform large cap stocks in fiscal 2023. So it was a continuation of the underperformance that we saw in the previous fiscal year. So here on this slide, if you look at the upper left-hand corner of this page, one sees a table where we've classified the constituents of the Biotech Growth Trust into three market cap categories: large cap stocks greater than $10 billion in market cap, mid cap stocks between $2 and $10 billion in market cap, and small cap stocks less than $2 billion in market cap. And if you compare that market cap distribution with the Nasdaq Biotech Index, our benchmark index, you can see that we started this recent fiscal year significantly underweight large cap stocks and significantly overweight small cap stocks. And that relative weighting basically persisted throughout the fiscal year. So if you look at the lower right-hand corner at a snapshot of that same market cap breakdown at the end of the fiscal year, March 31st, 2023, the relative weightings in terms of being underweight large caps and overweight small caps largely stayed the same. Now, in those intervening 12 months, if one plots the average stock performance of the MBI constituents in each of those market cap bands, you can see that large caps significantly outperformed small and mid cap stocks by about 25 to 27%. So obviously, given the way our portfolio was structured, that was a significant headwind to relative performance versus the index. Now that begs the question as to why we positioned the portfolio in that way at the beginning of the fiscal year. And it was really because the previous fiscal year had seen a very similar dynamic where small and mid-cap stocks really underperformed large cap. So if one takes a look at the market cap performance of the constituents of the NASDAQ Biotech Index starting from the beginning of the previous fiscal year, March 31st, 2021, you can see during that those ensuing 12 months, quite a bit of underperformance among small and mid-cap stocks. And we had expected going into this most recent fiscal year that that performance gap was going to close. In other words, that small and mid-cap stocks would revert to historical valuations and catch up to their large cap peers. That did not happen this past fiscal year. Now, encouragingly, we have seen stabilization of valuations in small and mid-cap biotech. So it's our view that there's not much downside from here from a valuation perspective for that segment of the biotech universe. But we haven't quite seen the recovery yet. We do have high conviction that a recovery will happen and a reversion will happen, and it's just a matter of time when it does, and hopefully over the next 12 months, that will indeed materialize. Now, one thing to note is that this small cap underperformance was not anything particular to biotech. So if one looks at the broader markets, at small cap performance as encapsulated by the Russell 2000, the small and mid cap index for the broad market, and compare that to the performance of the Russell 1000, which is a large cap index, again, plotting it from March 31st, 2021, you can see that over the past 2 years, small and mid cap stocks broadly across the market have underperformed large cap stocks by about 24%. And that underperformance was really the most acute and severe in what we would call unprofitable tech. So if you look at unprofitable technology companies across industries, not just healthcare, we saw significant underperformance in this particular part of the market. So here is the performance of a basket of stocks that Goldman Sachs put together called the Unprofitable Tech Basket. Again, this spans across industries. Only about 11% of this basket represents healthcare. And you can see since March 31st, 2021, a significant 58% drop in the performance of this basket. So by no means was small cap biotech sort of an isolated phenomenon in terms of underperformance. This is something that was occurring market wide and really a macro factor that was present in the marketplace. Now, why are we still so bullish on the recovery in emerging biotech? Well, here's a slide that shows the XBI versus the S&P 500. So this shows the relative performance of those two indexes since 2006. The XBI is an equal weighted biotech index that many people use as a proxy for small and mid-cap biotech performance. And you can see that over the past 15 years, in large part, the XBI has outperformed the S&P 500. So the biotech has been a good place to invest over this period of time. But there are transient temporary periods of underperformance, as noted by these red circles, where the XBI does underperform the S&P 500. Now, notably, after each of these relative performance drawdown periods, you do see a nice period of outperformance of the XBI versus the S&P 500, shown by these green arrows on this graph. And what is so unprecedented and unusual about this most recent drawdown on the very right is really how severe it has been. It has been the longest relative drawdown of the XBI versus the S&P 500 in history. It has been the largest absolute drawdown of the XBI and the largest relative drawdown of the XBI versus the S&P 500. So the XBI underperformed the S&P 500 by over 70% over the past couple of years. Now, encouragingly, if one sees at the right-hand side of this graph, it does look like the drawdown is over. Things appear to have stabilized, but we have yet to see the outperformance recovery that we're expecting that's been the case in previous instances of a drawdown. So hopefully that does materialize. We do believe it will, hopefully over the next 12 months, and we should get a nice recovery of outperformance of small and mid-cap biotech versus the broader S&P 500. Now, I've talked a lot about relative performance. Let me talk about absolute valuations. This unprecedented drawdown that we've seen in biotech has really depressed valuations to unprecedented levels. So one way to look at valuations of emerging biotech companies, because they don't have profits yet, is simply to take a ratio of the market caps of these companies to the net cash on the balance sheets of these companies. And if one plots the median ratio of market cap to net cash on balance sheet for the biotech industry as a whole, Since 2001, which is shown on this graph, you can see that this most recent drawdown has really driven valuations on this metric to over 20-year lows. So we're now trading at levels that are below that of the dot-com bust, below that of the great financial crisis, below that of the infamous Hillary drug pricing tweet in 2016, really unprecedented low depressed levels. We do see some stabilization here, which is why we think there's not much more downside from here, but clearly this is way out of the historical norm and suggestive of recovery and reversion back to historical averages. So another way to look at this is just to plot the percent of biotech companies trading below the net cash on their balance sheet, shown here on the left-hand side of this slide. 20 to 25% of the entire biotech universe is now trading at market caps below the net cash on the balance sheet. And you can see in historical context, this has really never happened before, definitely not within the past 20 years. On the right-hand side, what this translates into is 100 to 120 biotech companies now trading at market caps below the net cash on their balance sheet. Again, really, really unprecedented, unusual, depressed valuations. Now, one of the principal factors accounting for this decline in valuation has been the recent rise in interest rates in the United States. And here is a graph showing the 10-year US government yield since 2004 in black. And down below, we've shown the Fed fund rate increases and decreases that have occurred. And of course, over the past several months, the Fed has been pretty consistent in raising interest rates in its bid to tame inflation in the United States. Now, I'd like to make two observations here. First off, this has obviously had an upward pressure on 10-year US government yields over the past 2 years. Emerging biotech companies, I would say, do not have any direct exposure to this interest rate increase because most of them do not take on debt. They mostly finance their activities via equity. But when doing an analysis of the valuation of these companies, that risk-free rate, that 10-year rate, is an input in the discount rate that we use to discount back future cash flows for these companies. So it will depress the net present value calculation and the valuations of those companies at the present time. Now, one thing I'd like to note is that if one looks at the 10-year rate, you can see on the very right-hand side, it does appear to have stabilized between 3.5% and 4%. That 10-year rate does already incorporate expectations for some further rate increases for the balance of 2023. And it also incorporates expectations for rate declines in 2024. So we don't think there's much pressure, upward pressure remaining for interest rates, long-term interest rates in the United States. And if you look at this policy that the Fed has instituted over the past several months, it has been highly effective in reducing inflation. So if you look at the inflation numbers year over year, the CPI shown here in blue, we have seen a dramatic decline in inflation since the middle of 2022 when it was at 9%. The CPI with the most recent data point in June is now at 3%. And that is very close to the Fed's stated target of 2% inflation in the United States. So we very much believe we're at the late stages of this interest rate hike cycle. And in fact, if rates decline in 2024 as the market expects, we do expect that to be a tailwind for performance for emerging biotech. Now, one other investor concern recently has been whether or not a recession will materialize in the United States. Will these interest rate increases by the Fed tip the US economy into recession? Now, we don't have necessarily a prediction or a view about whether or not a recession will materialize, but I think it is a good exercise to look at how biotech has performed in a recessionary environment. And here is analysis from Goldman Sachs that shows the median excess return of healthcare versus the S&P 500 during the last 4 recessions. If you look at the bar in the middle of this graph in light blue, it shows the performance of the S&P 500 healthcare index. This represents basically the healthcare constituents of the broader S&P 500. And to no one's surprise, the S&P 500 healthcare index does outperform the broader S&P by about 10% over the last 4 recessions. And that's because healthcare, of course, is a defensive sector and should be less economically sensitive. But what's most interesting about this graph is if one looks at the healthcare subsectors individually, it looks like biotech is actually the healthcare subsector that performs the best in a recession. So if you look on the very left-hand side, large cap biotech outperforming the most, followed by small and mid-cap biotech as captured by the XBI. So I think that is comforting to know that if a recession does materialize in the United States, that biotech is actually a good place to be, and that if one is invested in biotech, if history repeats itself, one should outperform the general equity markets during a recession. Here on this next slide is just a slide showing the performance since inception of the Biotech Growth Trust, since our inception as managers in May of 2005. Clearly, we had a very strong performance in 2019 and 2020, but because of this unprecedented valuation contraction that we've seen in this space, we have lost a lot of that outperformance. I can tell you that we remain committed and we're working hard to restore the outperformance of this fund. We do believe, again, that we are now at rock bottom valuations, so we don't expect there to be much downside, much more downside from here, and it's just a question of when that recovery is going to happen, which hopefully will occur over the next several months. Now, let me turn to some of the industry fundamentals and the investment themes that we're seeing in the sector at the moment. And really, the major point I'd like to emphasize in this presentation is the fact that the valuation declines that we've seen in biotech stocks over the past 2 years are really not reflective of the strong industry fundamentals that we're seeing. We are continuing to see strong innovation in the space, and let me just talk through some of those points. So on page 16 here, innovation clearly is the principal value driver of the biotech sector. And if one looks at the size of the whole biopharmaceutical industry pipeline since 2012, which is shown here, you can see that we're now at record levels. So the number of drug candidates in development for the whole industry is at a record level right now. And we've seen tremendous growth, 70% growth since the year 2016. So just in the past 6 years in the size of the overall industry pipeline. This growth is happening across all therapeutic areas. And one of the reasons or one of the drivers of that growth is really the advent of a number of novel drug development technologies, including RNA therapeutics, cell therapy, gene editing, and gene therapy that have really taken off in just the past 5 years. So here, this is a graph showing the number of pipeline products based on each of these novel drug development technologies since 2012. And you can see in just the past 5 or 6 years, a tremendous increase in the number of clinical candidates based upon these next generation technologies. Now, one thing I'd like to emphasize is the fact that we are still very much in the early stages of seeing these technologies reach their full potential. So far, we only have a handful of products that have reached the market based upon each of these novel drug development technologies, and there are hundreds more clinical candidates still in clinical trials that are working their way through the development process. We do expect dozens more of these next generation products to reach the market over the next several years. And when they do reach the market, we believe they are capable of delivering significant revenue for the companies involved. So this is a slide showing 10 recent biotech product launches. And in each of these boxes, we have shown the consensus broker estimate for the peak sales potential for each of these drugs. And you can see that every single drug on this page is expected to deliver peak sales in excess of $1 billion. And that is the threshold that is classically used to define a blockbuster drug. So every single drug on this page is expected to be a blockbuster. Some are expected to be a mega blockbuster with peak sales in excess of $10 billion. And the other thing I'd like to note about this slide is that some of these boxes have 2 companies associated with them. And that's because the typical life cycle of a company, if a biotech company successfully originates a product, they are frequently acquired at some point during their life cycle by a larger player. So while most of these products were originated by a small biotech company, they are actually marketed by a much larger pharmaceutical company. And I'll touch on M&A trends in a moment in this presentation. So I mentioned sort of one of the rationales for having this emerging biotech bias in the portfolio has been the fact that we do think valuations are particularly dislocated for that segment of the biotech universe. We think there's much more upside in the smaller emerging biotech names from current levels. But there's also a very fundamental reason why we believe having a bias towards emerging biotech makes sense for this portfolio. And that is because if one looks at the source of innovation in the biopharmaceutical industry right now, more and more of that innovation is coming from emerging biotech. That is illustrated by the graph on the left, where if one looks at the share of industry R&D pipeline by company type, you can see that emerging biotech in light blue is increasing its share of the total industry R&D pipeline. It now is responsible for nearly 2/3 of the entire drug industry's R&D pipeline. So that trend does not appear to be abating at all. We think that will continue to grow. And if one looks at the source of origination for novel drug approvals and launches since 2012 on the right, you can see here again in light blue, it indicates the products that were launched originated by emerging biotech companies. And in 2021, emerging biotech companies originated over 50% of the new drugs launched that year. And so that is why we believe that having an emerging biotech bias in the portfolio does make sense. We want to mirror the source of innovation that's actually happening in the industry, and most of the innovation is happening in emerging biotech. Now, as a Biotech Growth Trust shareholder, one does get exposure to a lot of these novel drug development technologies. And here is a graph showing the NAV percent exposure in the Biotech Growth Trust to a number of novel technologies, antibody drug conjugates, gene therapy, cell therapy, oligonucleotide therapeutics. There is some double counting here because some companies do play in more than one technology. But the takeaway from this slide is really that as a shareholder of this trust, you will get nice exposure to a nice cross-section of the latest and greatest technologies in biotech. Here on the next slide, page 21, I just wanted to highlight a number of significant innovation milestones in biotech over the past year, just to give you some concrete examples of the innovation we're seeing right now in the space. So this is a slide that shows some selected first-in-class approvals that have occurred, as well as some important clinical trial results. The past 12 months have really been an important time period for gene therapy. So if you look at the upper left-hand corner of the slide, you do see that the first ever gene therapies were approved for hemophilia A and B. We also have the first gene therapy approved for Duchenne muscular dystrophy. And in the upper right-hand corner, the very first topical gene therapy was just approved for a rare genetic skin disease. So this is a gene therapy that's actually applied to the surface of the skin. In terms of RNA developments, if you look at the lower right-hand corner of this slide, Moderna obviously is most famous for developing an mRNA-based COVID vaccine, but they've also actually recently, in partnership with Merck, announced some very interesting positive phase 2 results of an mRNA-based cancer vaccine that has been shown to reduce the recurrence of melanoma. So that's also a very, very exciting result. So really quite important advancements across a number of technology areas in biotech. And really, I've listed these concrete examples here to show how robust innovation right now is in the biotech space. Now let me turn to the regulatory environment. This is a graph showing the number of new drug approvals at the FDA since the year 2000. We have had a constructive regulatory environment for the past 5 or 6 years, where the FDA has been very proactive about approving new drugs. You will see, though, on the slide, a dip in new drug approvals in 2022. So it did dip to 37 new drug approvals in 2022. We attribute that most likely to COVID-related delays. If one looks at the number of drugs approved year to date for the first half of 2023, you can see that 26 new drugs have been approved in the first half of this calendar year. And if one annualizes that rate, it does seem like for a full year 2023, we probably will again achieve a total drug approval number in excess of 50. And that's consistent with the elevated approval numbers we've seen over the past 5 to 6 years. So we don't think there's been any change whatsoever in terms of the FDA's attitude towards new drug approvals. We think they will remain constructive. And actually, they've shown quite a bit of flexibility in approving drugs recently with imperfect data sets if those drugs do address unmet medical needs. Next, let me talk about M&A activity. This has been a historical driver of returns in the biotech sector. Here is a graph showing biotech M&A activity each quarter since the beginning of 2018, where the target was a publicly traded biotech company. And you can see that in just the past 5 or 6 quarters, a noted acceleration of biotech M&A activity. And that acceleration is in part due to the fact that we're seeing such low, unprecedented valuations among biotech targets. So here on the next page, page 24, we have listed here a number of selected examples of biotech acquisitions that have been announced in both 2022 and 2023. And we've also listed the percent premium that was paid by the acquirer for each of these acquisitions. One thing I'd like to point out is that you'll notice that a lot of these premiums are in excess of 100%. So we're seeing triple-digit premiums in many cases for these acquisitions. And I think that also is very supportive of the view that the targets of these acquisitions are trading at such low valuations that even at a triple-digit premium, the acquirer finds it value accretive to the acquirer to make that acquisition at that price. So it just does show how beaten down a lot of the valuations are among emerging biotech. Now on this slide, we also have marked with a red star transactions in which the Biotech Growth Trust actually held the target at the time of announcement of the acquisition. So this trust does directly benefit from this M&A activity, and there are many other holdings in our portfolio that we think would make attractive M&A targets for a larger player. Now, I mentioned valuation as one reason why we're expecting to see M&A activity continue to accelerate. But another very important reason is the fact that Big Pharma is facing a significant patent cliff on a lot of their blockbuster products in the second half of this decade. And so here on the left is a graph showing branded sales at risk due to the loss of exclusivity, where these branded products are going to face either biosimilar or generic competition. We estimate nearly $250 billion in branded sales are at risk in the second half of this decade. And we've listed some examples of those products on the right-hand side of the slide. You can see that some of these products really are delivering current revenues for these companies in excess of $20 billion per year. And so there is a large revenue gap that Big Pharma really will face in the second half of this decade. How are they going to solve this problem? Well, they're going to be acquiring smaller biotech companies that have late-stage products to help remedy that revenue gap. So we do think there's an urgent need by Big Pharma right now to acquire biotech companies, and that is why we expect this accelerated, enhanced, elevated biotech activity that we've seen thus far to continue for the balance of 2023 and into 2024. Let me now turn to the political environment. Drug pricing legislation and the specter of drug pricing legislation has been an overhang over the biotech sector for decades now. I'm happy to say actually that drug pricing legislation was finally passed in August of 2022 as part of Democrats' Inflation Reduction Act. Now that act was primarily designed to push through a number of climate and energy initiatives, and the drug pricing reform portion of that legislation was meant to pay for a lot of those initiatives. Now, ultimately, the impact of the bill we think is manageable for the biotech industry. The law does call for Medicare price negotiations starting in 2026 for a limited number of drugs that have no biosimilar or generic competition by 13 years post-approval for biologics and by 9 years post-approval for small molecules. There are some other provisions in the law, including caps on out-of-pocket spending on drugs. We think that's actually a positive for the industry. And so ultimately, we don't think there's going to be any near-term pressure on the industry from this law. Over the long term, though, we do expect this may incentivize biotech companies to pursue biologics rather than small molecules because the time to Medicare price negotiation is longer for a biologic. Ultimately, we think the passage of this legislation does clear an overhang for the sector. Now that major legislation has passed, we don't expect Congress to take up the issue of drug pricing for several years, especially because Republicans have just won a majority of the House in November, and we think that really makes additional drug pricing legislation even less likely. Now, I'd like to point out the fact that multiple pharmaceutical companies have launched lawsuits against the government to block implementation of this law. So we very well may see actually the law get watered down even further over the next several months as those cases work their way through the courts. So the final message here, again, we think passage of drug pricing legislation clears an overhang and should allow the sector to re-rate. Here on page 27 is just a snapshot of the portfolio holdings of the Biotech Growth Trust as of June 30th, 2023. You can see that as of that date, 82% of the portfolio was invested in the United States, and that's because most of the innovation in biotech is still occurring in the United States. We do have some exposure in Europe and the Far East, which is mostly China on the right-hand side of this page. China actually now represents 15% of the early drug development pipeline for the entire biopharmaceutical industry. And so we feel like it is prudent to have some exposure to capture the growing innovation in China in the portfolio. If you look at the lower right-hand corner at the cash figure, it shows a negative 3.7% value at the end of June, and that means that basically the portfolio was 3.7% geared at that moment in time. That's a little bit lower than the ongoing gearing rate or gearing level that we expect to see in the portfolio of between 5 and 10%. And that gearing level will fluctuate up and down depending upon the opportunities that we see at any given time. So to summarize, what is the strategy and outlook for the balance of 2023? Well, we're going to continue to emphasize emerging biotech over large cap biotech because we still firmly believe that a sector rebound is going to occur, and that sector rebound is going to offer the most upside among emerging biotech companies. So we are going to continue to capitalize on compelling investment opportunities in companies that need to finance at low share prices. The gearing level, as I mentioned, will generally stay between 5 and 10%. I can't emphasize enough how unprecedented the valuations we're seeing right now in the space. We're really at 20 plus year low valuation in emerging biotech that we think suggests significant upside from current levels. The performance drawdown of small and mid-cap biotech versus the S&P 500 has been the longest and most severe in over 20 years. We're seeing 20 to 25% of the entire biotech universe trading at market caps below the net cash on their balance sheets, again, way out of historical norms. Valuation levels now are lower than that of the great financial crisis and lower than that of the bursting of the dot-com bubble. And we do believe that the interest rate headwinds that the sector has been facing are likely to abate in the near term. We think we are at the later stages of this current interest rate hike cycle. If a recession does materialize in the United States in the coming months, we think biotech is also a great place to be because historically that particular healthcare subsector has outperformed the general markets during recessions. I can't emphasize this enough. The valuation contraction we have seen in the space is really disconnected from the fundamental innovation in the sector, which remains robust. M&A activity we do expect to continue to increase given the low valuations of biotech targets, as well as the urgent need for new products by Big Pharma as they contend with a patent cliff in the second half of this decade. Passage of drug pricing legislation recently, we think, does remove the persistent political overhang that's clouded the sector over the years. And then finally, China stocks generally have had some different macroeconomic pressures that have compressed valuations there, but we do think that part of the portfolio is poised to rebound with the post-COVID reopening. So overall, I think while we had a very difficult period of performance, we are working hard to restore long-term outperformance of this fund, but we really do firmly believe that we've reached rock bottom levels in terms of valuation for emerging biotech in particular. We don't think there's much more downside from these levels, and we think that as a long-term investor, if you're interested in getting exposure to this very exciting and innovative part of healthcare, it's actually a great entry point to get into the sector when valuations are so low and innovation is so strong. So with that, thank you very much for your time, and I'm happy to answer any questions.